And welcome everyone to another Smart Money Circle episode. I'm Adam Sarhan. With me today is Tim Smith, who's the founder and CEO of Aurora Private Wealth with about $4.4 billion in assets under management, advisory, and supervision. Tim, thank you so much for taking the time and welcome to the Smart Money Circle.
Well, thank you very much. Thank you for having me.
So, Tim, I always like to ask your story. Can you begin by please letting us know how you got to where you are today?
Well, sure. I actually started in life as a child actor singer. Believe it or not, I've continued to sing over all the years. Some people know me as the guy who sings the national anthem before a lot of national RIA conferences. But put that aside, in 1985, so it's a long time ago, I started with a financial planning firm in northern New Jersey. I was there for 10 years. I left and started my own RIA firm, and I thought I would just be on my own and kind of managing money for people. And then some of my friends wanted to join me, so I started a broker dealer for them. And that broker dealer started to expand because we started getting referrals from companies like what is now TD Ameritrade, Schwab, and Fidelity. The company just expanded over the years, and we are now about 100 advisors in 35 states. There is, as you mentioned, about 4.4 billion among the broker dealer, two RIAs, and a fixed insurance entity, as well as about $10.6 billion of unaffiliated RIA business for a group of the advisors that we work with on our broker dealer side and that we have to supervise their outside RIA activity. So, it's a very nice business. It's a very comfy kind of a thing for me to run, and I really enjoy it. I love it.
I love it. Well, congratulations on the success. I love success stories. So
Thank you.
let's ask the question, Tim, about your business. Please tell us about your business. But in your case, please tell us about your businesses, what you do, and some of your competitive advantages.
Sure. I would say the first competitive advantage is a boutique feel. We really, really work very hard to have good relationships with our advisors, to take great care of them, kid glove, white glove kind of treatment for them. They can always call a compliance officer or the chief compliance officer at any time and just go over any questions or issues that they're having. So that degree of intimacy, I think, is a major advantage for us. A second advantage is that we work extensively with advisors who have started their own RIA firms. This has been a huge trend for the last 30 years. And, people leaving Merrill Lynch and becoming, Adam Sarhan Advisors, Inc., and still needing a broker dealer to process part of their business. So we're one of the leaders in the country in that particular niche market, if you will, which has been a big part of our success over time. So we're called fee friendly. From a marketing perspective, we allow people to market under their own names and create their own advertising and websites and all those kinds of things so that they have their own branding. And I would say finally, it's just very competitive pricing with the market, and that a lot of people really appreciate because a lot of the companies have all kinds of costs and fees and things like that, and by the time they see their actual payout, it's far lower than they were sort of led to believe would be their payout when you get to the effective payout. So those are our main advantages in the marketplace.
I love that. It makes perfect sense. So you're able to offer solutions to people that want to leave the big brokerage firms, just to translate for the audience. And typically the big brokerage firms, the brokerage firm, Merrill Lynch or whoever, Morgan Stanley, they take the lion's share of the wealth, the commissions or the revenue that's generated, and the individual advisor gets left with a smaller amount. What you're able to do is competitive advantage. You say, hey, listen, we can offer the same services the big firms do, but you get paid more money. So you keep
Yeah,
more of it.
correct. And really, advisors hit a certain point of experience, I would say, where all of the advantages of the very large companies in terms of various kinds of support become less advantageous to them over time, less needed by them over time. And as a result of that, they look at it and say, wow, I'm getting 40% of the money here. I'm doing 100% of the work here. And, I'd rather get a different balance because I just don't need that much from the company anymore for my practice. And that's what's been driving and fueling essentially an exodus from the very large firms into what's called the independent space in the financial advisory marketplace. And we have benefited from that.
Got it. No, thank you for that. That's a brilliant point. And thank you for that clarification. Where early on in the financial advisor's journey, they could benefit, but as they get to a certain point, it's like, hey, there's no point. So that makes perfect sense.
Yeah.
So, next question for you, Tim. Let's talk about risk management. What are some mistakes you see people make with respect to risk management, and how do you learn from them or avoid them or reduce risk?
Well, yeah, there are a number of aspects to this. So most financial advisors today are driven by something called modern portfolio theory. And in fact, if you are unfortunate enough to end up in an arbitration, the other side may very likely bring up an expert in modern portfolio theory who will say, you did not follow modern portfolio theory. And as a result of that, the client was damaged somehow. So modern portfolio theory typically has to do with asset allocation, diversification, some of the concepts that we're all familiar with. But it's a little bit, well, if you don't fall into that as a normal practitioner, then you're just at greater risk with clients. So, for example, if you come from kind of a stock background and you like the idea of just holding 5 hot stocks for clients, if that's what you do, you have to be very, very careful to not tell people that you are a financial planner, financial advisor, someone who does portfolio management per se, because you would not be following modern portfolio theory and you would be putting yourself at risk if the 5 hot stocks crash on you. So that's a risk that I see a lot of people, in particular individual investors, who don't have modern portfolio theory background or experience. They like the idea of picking stocks, and they like the risk, and they like the potential for great returns. And everybody wants to pick the next NVIDIA, right? So you can get rich quick scheme kind of a thing. So lack of diversification would probably be the first thing. I think that a lot of people go into the stock market in particular, and the bond market to a large degree, without appreciating the various kinds of risks that they're subjecting their money to. When people like me study investing, and I'm a certified financial planner, anybody with a CFA or, a background in a lot of these things will have training in these areas, but things like purchasing power risk, credit risk, business risk, industry risk, there are just more levels of risk, and diversification is a main way of dealing with that. So personally, I think educating clients on this stuff is really important to get them to understand why we're trying to shepherd them in a particular direction with their money. So, the main risks that I see people taking are lack of diversification, I would say, just a failure to appreciate economic cycles, what is normal for the market to go through, and to a certain degree, panicking when things are tumultuous in some regard. I just, for example, right now, we're in a time where tariffs being put out by the Trump administration are causing tumult. They're causing issues with relationships with other countries, et cetera, et cetera. And so a lot of people are concerned, and the market has dropped somewhat from its peak of a month and a half ago or so. So I will get some calls from people saying, what should we do? What should we do? My feeling is, in general, I've positioned you for probably at least a 1 to 5 year time frame, not for a 2-month time frame. And this is all what I would call noise. So a lot of people pay attention to the media, and they're glued to CNBC, which is more of a trader show than an investor show. I mean, a channel. And I generally find that level of emotionality is what leads people to make bad decisions. They'll sell at the bottom of markets. They'll try to reposition for something that might happen the next month instead of, really thinking more long-term, at least near term, than a month. I think the other thing, and I happen to be a believer in asset allocation theory, but I also use structured notes, puts, and calls to give people downside protection while maintaining their upside potential. So, and this goes against the concept for financial advisors of scalability. In other words, listen, if you talk to a coach that's going to help you double your AUM in the next couple of years, right? They're going to tell you that you need to have a scalable management system so you can just throw as much money onto the system and have it self-managed to the maximum degree possible while you go gather more assets. That's fine as far as it goes, but a lot of clients need something much more customized, and particularly large clients expect something much more customized than that. So, they're not looking to just be put with a large asset allocation third-party advisor who's going to buy a series of mutual funds or ETFs and, leave it basically for a while. So I think that a lot of advisors don't look at the full panoply of what's available to help risk manage for older, in particular, older, more conservative clients, which that tends to be the kind of client that I work with. Somebody with $3 to $5 million or more, they are concerned about losing the legacy that they've built or watching it go down and things like that. So, I do some things that go far beyond just asset allocation, but they are not scalable because they're customized. And so as a result of that, when I have a custom portfolio like that, no two clients look exactly alike. One client might say, hey, I don't want to lose more than, 10% of my money. I don't want that kind of risk, but I still want the stock market's returns. Okay, well, that's going to be different from someone who says, I don't want to lose 25% of my money, or someone who says, you know what, I'd be okay with market downturns, but I really want more market upside, in which case there might be calls and structured notes used that have more leverage to the upside and one-to-one downside. So risk management, for me at least, involves not only diversification and asset allocation, but it also involves using additional instruments that I think a lot of advisors choose, either aren't aware of or choose not to use because they think it makes their practice more challenging, less scalable, but quite frankly, they'd get larger investors if they would do it. So, but so risk management has a whole series of different aspects to it, and I think that the clients make some mistakes, the advisors make some mistakes.
That's a great answer, by the way. Thank you for that. So you're saying risk management, instead of looking at tick by tick or day by day, or even, really short-term horizon and making emotional decisions, it's really important to step back, look at the longer term, but also create a custom solution for you and your risk tolerance. So if you're comfortable having puts or any other strategy, by all means do it. But once you pick a plan, stay to it, stay the course. Don't keep shifting mid-game just because the market goes up or down.
Yeah, correct. Listen, the market over near term and long term, it tracks economic cycles. If there is economic growth and if that growth continues, the market tends to trend up. If we have a recession, God forbid a depression, or deflationary period of time, the market tends to go down. And then you get shock impacts like the pandemic, okay? Which, if you think about it, the S&P 500 dropped 37% in a short period of time, but 6 months later, it was right back where it had been and moved on. So shock impacts tend to be more short term, and people don't appreciate that. Economic fundamental problems, wheels coming off the bus, let's call it, like banks closing down, brokerage firms closing down, like 2008 and 9, that's where you get sustained longer term market downturns. Or take the dot-com bubble in 1999. You had companies with no revenues going public at $2 billion of value when there was no valuation metric to match it against or to make sense of it. So when you get gross overvaluation, you're subject to gross correction. if you think
Yep.
about it. So you just have to stick with the economic cycles, the ups and downs of the economy. If the economy is growing, and if the economic fundamentals, the underlying underpinnings of our financial system, if they are strong, it's very hard to get a severe market event.
Got it. No, that makes perfect sense. And that's a very good clarification also. A short-term shock opposed to systematic change. Like you
Yes.
mentioned, the entire investment banking business imploded. The five largest investment banks all changed or went out of business or got acquired. So,
Yep.
Bear Stearns was gone, Lehman's gone, and
Yep.
then Merrill got bought up, and then it leaves you with
Yep.
Morgan and Goldman. They just say change to a commercial bank. So yeah, that's a great point. Okay,
Yep.
next question for you, Tim. What are some timeless lessons you've learned along the way about life or about business, about markets, anywhere you want to go that you'd like to share with the audience?
Well, life is all about relationships and love. So focus on those two things. And relationships and love are about communication. So, focus on those things in your personal life, and you'll avoid an awful lot of pain and problems and everything else. And believe me, I've made my mistakes in those areas. So I'm speaking from experience. Um, Business wise, I think even businesses have to have risk management profiles in place and procedures and things like that. So, just as an example, we could get a very large commission in which, if there were a chargeback of that commission or a problem with that commission in our broker dealer, it could actually threaten our net capital if we have already paid out that very large commission to an advisor. So we have to have procedures in place to ensure that something it cannot be charged back. We're past any period of time where it could be charged back, if that could be a problem for us. And so uh, every business has to have ways that it looks to protect its business from exogenous shocks as well as problems from within. So I think that business wise, you need to do that kind of thing. What was the third thing? Was it leadership? Did you ask about, or forgive me?
This is just timeless lessons. We're going to get
Oh,
to leadership
timeless
in
lessons.
minutes. Yeah,
Yeah,
this
yeah.
is just timeless lessons.
I'll go back to business then. So, also in business, communication and trust are critical. In a business like mine, where we work very closely with financial advisors day to day, they need to be able to trust me. I need to be able to trust them. And quite frankly, from a regulatory perspective, I'm not allowed to trust them, or it's unwise to put too much trust in someone. I've had my trust betrayed a couple of times by financial advisors who literally stole money from clients and things like that. I actually am finishing a book about financial advisor investment fraud, which is a lovely topic if you want to go into that in more depth. But trust but verify sort of things I think are critical in any business relationship. But again, relationships with third parties like TD Ameritrade, Schwab, et cetera, are what built my business. So their relationships have been very, very critical, and good communication and trust, and them knowing that we will do the right job for people if they refer business to us, and the same with us giving them business back. Um, those are really the key things. Like, I just find that most of life has come down, and I'm almost 62 years old. Most of life has come down to relationships, trust, communication, love, just doing the right thing. Very, very basic stuff that, somebody talked about a couple thousand years ago, that's right, or longer. It's been going on for even longer than that. Um, to do well by other people. My whole belief of the creation of wealth is that you create wealth by serving other people. The
Right.
more other people you serve, the greater the wealth you develop for yourself. So, when I have arguments with young people about the capitalist system, or things of that nature, I try to point this out to them. How did Elon Musk become the wealthiest man in the world? Well, he provided value to millions and millions of people, and that's how you become wealthy. So if you look at it that way and you treat it that way, you can become wealthy also, as long as you go for it.
I love it. Okay, how about the other side of that coin, the timeless mistakes? that either you've made, you've seen other people make, and how do you avoid them?
Yeah, I think taking things for granted, taking people for granted, have been mistakes in my life. Being taken for granted, I suppose. Um, not communicating clearly, not being trustworthy. I wouldn't say that that has been a problem for me so much, but I know that if someone feels they can't trust you, it's a problem, right? I think being too aggressive in growth plans hurt my business at certain points in time. The saying is getting ahead of your skis, I guess. Um, Not having a business plan at the very beginning, a formal business plan. I had something on paper that was sketched out in 10 minutes, but today I'm a big believer in much more formal business planning. It helps you to, I actually am consulting with 3 or 4 companies right now on business planning, strategy planning. And I find that it helps an entrepreneur, a CEO to focus on the critical rather than all the great creative ideas, which, we can all have great ideas and throw them against the wall and see what sticks. But ultimately, you don't have the resources to do everything you want to do. So you have to come down to decisions, and trying to do too much at any given time is another reason that companies have trouble. They spend money to do a lot. Some of it gets no return, and they find out that their cash is gone, and they don't understand why they don't have as much revenue as they thought they would have. I'll tell you the other lesson I've learned: revenue never comes as fast as you expect it. So whatever you do in your business planning, and you're going to expend money on marketing, whatever it might be, don't expect the money to come as fast as you think it will come. Just plan for it to come in a much longer, significantly longer period of time. By being conservative like that, you'll be pleasantly surprised when it happens faster, or if it happens faster, but you will not be caught, with your pants down, so to speak, by having expected revenue too soon. And I think that early in my career, that was a big mistake that I made probably for several years in a row. And I'm a little thick. It took me a little time to learn that one, I guess. But that's a big lesson. And the other thing is just great people. Hire great people. Hire people that are going to be loyal, that are going to work hard for you, and treat them great. I have a business partner in this business. We've been together for 25 years, I guess, at this point. And he is a billionaire, successful businessman. And his entire mantra with me when I started up with him was find great people, let them do what they do, and treat them great. Treat them with love, treat them with respect, treat them with dignity, and they will go to the moon for you. And boy, has he been right. Because I have some amazing employees who I wonder every day how I got so fortunate to have such good people that I work with every day.
It's so incredibly powerful. Thank you very much. It's a slice of heaven. So, okay, wonderful. Next question for you. Now let's talk about leadership. So, as a leader,
Okay.
multiple companies, you've made mistakes, you've succeeded from them. Let's talk about leadership. What lessons have you learned about leadership, and what makes a great leader?
I would refer to the book by Rudy Giuliani, who otherwise is, pretty much disgraced these days, I guess. But his leadership of New York City in the 1990s was an amazing turnaround. I used to go into the city on a very regular basis when I lived in northern New Jersey, and he turned around that city. And his book tells you how he did it. But all leaders have to have certain characteristics, I would say. One is vision. They have to be able to see something that isn't and want it to be, and see how it can be, how you can get there. And obviously, it has to be something valuable, something worth doing. But vision is a really critical element of it. I think there's a certain amount of creativity a leader has to have, in particular for problem solving, because you never have enough resources to take care of every problem or every issue that you deal with. So you have to find very creative ways to break through certain issues that will arise over time. So definitely creativity. I'll go back to the positivity and the manner of treating people. I just am, like my mentor, I'm just a huge believer that leaders, the leader who berates people, the leader who talks people down, who criticizes them, especially publicly, the leader who doesn't create a culture of dignity, respect, love for working together, love for what we all do together. That kind of leader, and I know I'm sort of telling you what kind of leadership qualities I like by telling you what I don't like, but that kind of leader, and I dealt early in my career with that kind of leadership. And I saw how it drove me away ultimately. That kind of leadership, it works for a time, but it results in higher employee turnover. It results in lost relationships. It results in a lack of richness in life, I would say. I can just tell you my life is very rich. I have wonderful people in my life, employees, clients, vendors, family, friends. I'm extremely blessed, but I think a lot of it is because my leadership style is one of collaboration, cooperation, praising other people when they do right, finding them doing right. There's a kind of a saying about that. Never criticize them in front of their coworkers. There's nothing more demoralizing than to take a dressing down from the boss in front of other people. And how you dress people down, I think, as a leader is really critical. Trying to find the positive and here's what we're going to do about what I see as a problem or an issue, is far more important than just venting and getting that issue out for your own, emotional desire to rip somebody, and believe me, I mean, I'm subject to that desire, just like everybody else is. And I was not a very good manager or leader, I would say, early in my career. These are things that I learned over time with the help of my mentor. I had to unlearn some things from a prior company, and thank God I did, I guess. So just some other characteristics I would say quickly. I think this may sound funny, but how to be a friend without being a friend. So in other words, you want people to feel that they can come and talk to you, especially if they have a problem, but you don't want them to feel like they are friends. And I know that may sound a little rough, but I've never been friends with an employee. Not really. In other words, socializing with them, having lunch with them. I know it might sound funny, but I eat lunch by myself every single day. I keep a certain barrier. And I think that keeps a certain respect for me, that no one feels so close to me that they could either try to manipulate me or somehow take advantage of that. So I think that leaders do have to maintain what I'll just call a professional distance from the people that they lead. And it's unfortunate, but I do think it's important. Lastly, I think leaders just in general need to be generous. My employees, I try to give them the maximum bonuses I feel I can afford at a given point in time. And I try to be free with praise. If someone says to me, "Hey, Tim, my school is trying to raise money for X, Y, and Z," well, yeah, we'll send them $250 and we'll end up being the biggest donor, as it turns out, half the time, and I give a lot away. And it's just my belief system that the fortunate have to be generous with others. So I think there's a lot of Jack Welch has his book, or had, I guess he's passed away. He had his book on leadership. Rudy Giuliani has, his way. Elon Musk, I'm sure, has his way. Maybe the last point I would make is, finding what is true to you. What really fits your way, and yet has basic principles of management and leadership met. I think that's maybe the last thing I would say, because if you're not true to yourself, if you're not being real, um, yeah, I think people can tell when somebody's not being real, and I
I
don't think
love
it
it.
helps.
Yeah, no, that's very, very powerful. And thank you for that advice. I guess final question for you today, Tim, is what's the best piece of advice you'd like to give the audience or your 30-year-old self?
Lower your expectations. No, you know, uh, I think life is a series of whipsaws, to use the market term. Okay, uh, life has ups and downs, and a certain sense of. I wish when I was 30, I had had more detachment than I have today. More of an inward focus. Today, I do things like meditation and, just sort of morning rituals that are designed to help me just center and, focus on peacefulness and things like that. I think when I was 30, my engine was running a lot, and I was probably pretty much a maniac a lot of the time. Um, so I would say to myself, get centered, stay centered, um, expect ups and downs, be ready for them. Don't let the ups change your belief of who you are too much. You know, there's an easy tendency to allow arrogance to seep in when you're successful, to think that it's actually because of you, right?
Yeah.
You know, it is and it isn't, right? It is because of you, because what you've done, but it's not because you're arrogant, right? It's because you offer something that's of service or value, you do it well. That's why it's happening, not because you are such a great person or think so highly of yourself. So when things are good, maintain an even keel. When things are bad, maintain an even keel. They will turn around. Things will get better. It's the same with markets as it is
Yeah.
in life. And, don't be afraid to seek help when things are really bad. If you're really struggling with it, if it's interfering with your daily life, I can tell you, I've been through my share of therapy over things. And, when someone steals millions of dollars from a client, you start to question your own sanity. Like, why the hell am I doing this? What have I done wrong that, would cause these problems? And really just enjoy your life, and don't forget the people around you really make your life rich. It's the end of It's a Wonderful Life, the movie, you
Yeah.
know, to George Bailey, the richest man in town. And he's rich because people absolutely love him and appreciate him. That's how I want to be rich. And that's how I want to be remembered. So, I would say that to my 30-year-old self. And I would say that to anybody coming up with an entrepreneurial venture or trying to build or grow something, um, that you don't have to be, being rich is fun. You don't have to be a jerk,
Yeah.
or an arrogant jerk.
Mhm.
Uh, be yourself, and just build relationships with people. Keep on building those relationships with people. You never know how a relationship is going to come back in some good, the karma of it. You know what I mean? So I'm a huge believer. I will help anybody I can, anytime I can. Um, because the more people that owe me, the better. That's the cynical way of looking at it. But the more people I help, the more fulfilled I am in life.
Right.
And, it's a very rich way to live your life, to know that you're helping other people, and that you're paid, that your bills are paid. You know what I mean? That you're comfortable,
Yeah.
which is all I've ever sought in my life. So I'm competitive, but not terribly, I guess I would say.
I
So
love it. Well, Tim, thank you so much. It's been absolutely fantastic. I'm gonna have the description in the links with your bio and websites and all that fun stuff or anything that you want to share. This has been great. Hopefully we'll have you on again soon. Thank you very, very
Great. I would
much.
love it. Adam, thank you so much for having me. It's wonderful to, be able to put this out there for people. I really appreciate the opportunity.
Thank you.